Hello and welcome to yet another edition of Who Moved the Market. I'm Surabhi Upadhyay. Happy Friday to all of you. Well, the market, as you would have noticed at the index level, hasn't moved much. It's been range bound. And the all-time high, or technically that level that is, has been a bit elusive for the Nifty. In fact, we've been slightly grinding lower through the course of this week. We decided to put all of that aside because today is Friday and food is always a great conversation to have. So we said, why not? Considering a lot of the QSR or the quick service restaurant companies have already reported numbers. So let's figure out if the investment or the trade that you want to play can be as appetizing as the bite you want to have over your weekend. Well, to help us do this, I have someone with me who, of course, has been in the market for a very long time, but he's personally very passionate about this space and has been researching and reading and sort of, talking to us about these companies for many, many years. Rahul Arora, CEO of Nirmal Institutional Equities, is joining in. Rahul, great to have you on our show, and I think this is your first on our digital edition, so welcome to Who Moved the Market.
Thank you so much for having me, Surabhi. I'm very excited to be here.
All right, fantastic. It's a good conversation to have, especially as the weekend is coming up. But I really, want to sort of set the ball rolling with your broad thoughts, because if there's one thing that stood out, and I noticed that as I was, recompiling all the numbers from the listed entities, that there is no singular trend that stands out. There are companies that have faced margin pressures. There are companies that have done really well, 25, 30% kind of top line growth. And then, there are expansion plans afoot. What's your sort of overarching view when you look at QSR?
So I think, Surabhi, there are so many different franchises that are at play in India. Some of them are pan-India, some of them are regional, some of them are professional-driven, some of them are promoter-driven. So I think you've got to be very careful about what you select in QSRs, because within QSR, the kind of food that you actually buy from the listed entities is also very, very different. Whether they are promoter-driven entities, to what extent do they have headroom on margins? I think there are lots of things that are at play out here, return ratios. So I think when you look at them, you've got to drill really, really deep. And I think the way I look at this business is, this is a business that will probably top out at about a 75, 77% kind of gross margin. So it's more an operating leverage play. I mean, the question is how much you can grow your operating margin. And then, of course, that's basically a function of how you grow your average unit volumes and your same store sales growth. But I think how good you are with menu innovation, how good you are with premiumization, how good you are with product diversification, I think all of this sort of fits in. So I think when you say QSR, it sounds very simplistic, but I think, there is, as we do in a lot of companies, there are some of the parts, and I think this sector is no different from the others as far as that is concerned.
Okay, fair enough. Well, it's a margin game, as you said, and it's all about seeing how much more you can get for every rupee that you're spending on your expansion. And that's been the really interesting story. So I'm going to come to Westlife in a bit, because we all know that Westlife is, one story that you've liked for a very long time and continue to do so. But first, let's look at the others. I mean, Jubilant Food for itself, a franchise that we've all grown to, understand and sort of experience as customers, some of us even as investors. Margin pressure was really apparent even for Jubilant. So what is going on? Is this a temporary patch? In fact, if we're speaking of these names, even Sapphire, Devyani, margin pressure really stood out. So is this a temporary patch because of expansion, or is there another worry here?
No, so I think, Surabhi, there are three or four things here, right? I think the fundamental return metric that I look at a company, there are two aspects actually. There is cash flows and return on capital employed and return on equity. I think in the case of Jubilant, Surabhi, if you remember, in 2013-14, this company used to operate at almost 42-43% kind of return ratios, and the margins were also around 23-24%. And then, of course, it went into a downturn when the return ratios kind of collapsed, to the low to higher teens, and the EBITDA margin had come down to single digits. So I think the current operating environment should be for Jubilant is a bit tricky, because milk prices are really, really high, right? And milk is a key ingredient in cheese. And we've seen even some of the most docile players in terms of price increases, like Amul, for example, have gone in and taken price increases. So I think as far as the milk inflation is concerned, for the foreseeable future, I think that's going to stay. And I think from a cost standpoint, there's going to be some bit of an issue. The other, as you rightly pointed out, is store expansion. I think the fact that Jubilant is opening the kind of stores that it is, there is a lot of capex that's going to be required for these entities. While the erstwhile business does throw up cash, and it will still be a free cash flow generating company, but I'm not sure if at the start of a slowdown that we're looking at ahead of us, if that is necessarily the right strategy. The second important point also should be is that they have done geographical and product diversifications beyond India. So I think, some of the markets that they're present in have their own economic challenges, and I think, they'll have to sort of contend with that. And I think they've gone into other cuisines, whether it's a biryani or a barbecue nation or Chinese. So I think we'll have to see how all of these scale up. So I think it's not a pure play pizza, though of course that's the bread and butter. But I think what I would keep a watch on very closely as far as Jubilant is concerned is one aspect the prices of milk, which is a key raw mat in cheese, and the other is how this company is actually progressing in terms of capital allocation. The other, of course, is should be, even though the promoters own north of 40% in the company, there's always been this fascination about who heads the business, right? And I think somewhere the market hasn't gone to ascribing the same multiple that they did to Pradeep Pota, to the current incumbent CEO. So I think there's a little bit of delivery still left on the table. So my sense is, if you're looking it out from a one-year perspective, this could be a challenging stock to hold on to for various reasons that I have mentioned.
Okay, got that. I'm just looking at Nirmal's target price. It's an accumulate rating. Target price is 495. Stocks around, I think, 470 right now. So, well, that's limited upside over there. That's Jubilant. Since we're talking pizzas, I mean, the other companies there are the other two franchises. I'm talking about, of course, Pizza Hut now, and also you have the KFC business thrown in. Sapphire as well as Devyani. I know you don't have a coverage on these stocks as of now, but any thoughts? Because again, it's the same story. There is top line growth, but there's margin compression, and then there was some one-offs in Sapphire and Devyani, which is why there was a bit of pressure on the bottom line as well.
So I think, Surabhi, on the pizza business, it's pretty much the same, right? The milk inflation that applies to Jubilant will apply to the other pizza franchises, which is Devyani and Sapphire as well. The other point, Surabhi, is, a decade back, you had Jubilant that was practically the only QSR play to play in town. And to a lesser extent, McDonald's, because they were struggling with their own things about 10, 12 years back. I think the McDonald's story has emerged in a fascinating way over the last 10, 12 years. But then there's been other competition that's also come in from Jubilant in the form of some of the other listed entities. Now, as a shareholder, I don't have to buy all the QSR companies. I'll buy one, maybe two, and then I look for other consumer discretionary names. Now, I'll tell you what my problem is with some of these entities that have listed over the last couple of years. A lot of them, if you go through their DRHPs, a lot of their royalty benefits are actually linked to store openings. So if you go back to a scenario of 2013-14, where Jubilant kept opening 150 stores in a downturn and saw the impact on return ratios, I think some of these guys would have a similar challenge, because they'll have to keep incurring capex. Just look at what PVR Inox did the other day, right? So I think the fact that they announced that they're not going to do any incremental screens from what they've already announced, and they're shutting 50 stores, it's telling you a little bit about consumer sentiment. And some of these franchises that have listed in the QSR space will get very material benefits on royalty just by virtue of store opening. So if you're not going to get the desired benefit in terms of revenue, this cost is not going to be something that you're going to be able to recover in a jiffy. So your return on invested capital will see an impact. So I think from that perspective, I think there is, like I said, an inflationary environment for milk for the other pizza players as well. But the more concerning part is for the newer QSR companies, is that their royalty benefits are linked to capex, and if the revenue does not move commensurately, then there could be pressure on the bottom line, and quite substantially, because you will have depreciation and amortization to contend.
Got that. That's a really important point, and glad you brought it up, Rahul. In fact, let's see if our team can put up the same-store sales numbers, and that really exhibit what Rahul is saying. You can go on opening more stores, but how much more revenue are you generating per store? In case of Sapphire, for KFC, it's up just about 3%. For the Pizza Hut stores, it's down 4%. And similarly, for even Devyani, KFC is up 2%, Pizza Hut is down about 3%. Costa Coffee is different, of course. They're opening a lot more Costas. The base is very, very small. So that's a different story. Okay, so we've discussed the pizza makers, and let's now come to the burgers. And I know here that Westlife has been one of your most loved stocks, Rahul. Actually, I mean, milk inflation technically should be, hitting Burger King and McDonald's as well. But both these companies have managed to arrest any sort of a significant margin decline. In fact, I think there's a small increase in margins that both these companies have managed. So what's the burger story all about?
So I think, Surabhi, in McDonald's especially, there are multiple levers that are, sort of firing at the same time. And there are certain soft points and there are certain hard points. I think the softer point is that The management owns about 55% of the company, there and thereabouts, and they've not diluted their stake. In the case of Jubilant, I remember about half a decade back, or maybe even 10 years back, the promoter holding used to be north of 60%. That's come down to the low 40s. So the promoters have remained invested in the company, and I think the entire family is sort of invested in this business. So there is no key man risk, so to speak, from a McDonald's perspective. That is one. Second is their royalty benefits are not linked to store openings, and they have spelled out their royalty very, very clearly to investors, and given the trajectory on that. The point here being, Surabhi, I think when I talk about capital allocation, neither has McDonald's, which is Westlife, the district franchise, neither has it gone into other geographies, nor has it expanded its product portfolio beyond burgers. The only thing that they have done is premiumize their existing products. Say maybe a 20 rupee, aloo tikki burger has now gone to a 40 rupee or a 45 rupee aloo tikki wrap, and that's obviously been gross margin accretive. And they've gone into coffees, which is doing remarkably well for them through McCafe. I think a lot of times, Survi, what's lost on people is that the operating metrics, and I could go on and on talking about this, are so different for a McDonald's versus a Jubilant. And yet you will find that the gross margin of both these businesses is only 300-400 points different now. Jubilant's always been an entity that's operated at, between 70 to 80% gross margin. McDonald's used to be a company that was operating at about 55% gross margins, and now they're touching 70. In fact, in the quarter gone by, they were north of 70. So that's remarkable. The second important point will be this is predominantly a dine-in business, and it's probably on its way to going to a 40% return on capital employed, which is what Jubilant used to do at its peak, which is remarkable again. The third point is that it's getting very close to Jubilant's EBITDA margins as well. It's already north of 20% or just thereabouts, and Jubilance is roughly at about 23% or there and thereabouts. So the point I'm trying to make is, when you are in a delivery business, your operating metrics are very different than they are from a dine-in business. But here you have an entity which is predominantly a dine-in business, which obviously does delivery now, and that's probably become 25-30% of their business, but it's operating at a similar financial metric as the Jubilant network. The point here being that if these things converge, and they have been over a period of time, I see no reason why over a longer period of time Westlife can't be operating at the multiples Jubilant did over a period of a decade. And if that happens, the stock would still end up being a multi-bagger from here. So my sense is, Surbi, when I look at all of these factors put together, it is pretty much a no-brainer to me that Westlife remains. The interesting part, Surbi, I'll give you another fun fact which people don't realize. I think one of the only pushbacks that I get when we pitch this stock is that the management of Westlife is not that aggressive in store openings. There were a time they were opening 20-25 stores, then that became 30-35. Now they talk about 40-45. What people miss is that every one McDonald's store that opens is effectively 3 Jubilant stores that are opening.
Yeah.
Because McDonald's has about 3,000 square feet and Jubilant is about 1,000 square feet. So if McDonald's comes and tells you that I'm opening 40 stores, they're effectively opening 120. And let's compare it to the other listed. It's just such a beautiful business. And I'll tell you, if you just look at Burger King, right? Burger King is a pan-India player. The top line of McDonald's with half of India is higher than that of Burger King. And every other margin metric is better.
But Burger King is a late entrant as well, Rahul. I'm just trying to play the argument from the other side. Burger King is a late entrant. I take all your points on Westlife because as consumers, you walk in and you see what they've done in their stores. You see the products. You see McCafe. You see some peri-peri burger that I ended up having on my last road trip. All those points are taken. But Burger King has come in. Could that not be a significant competitor if the metrics are pretty similar?
No, I'll tell you why, Survi. I think there are 2 or 3 things here. I think, despite the fact that Burger King has present in the north and the east, which is predominantly a non-vegetarian market, and I think you can price the non-vegetarian products higher than you can price your vegetarian products, their gross margin profile is still inferior to that of Westlife. The second important point being, I think, as you rightly pointed out, since they're a late entrant, I think they'll have to invest a lot more in terms of advertising and promotions than a McDonald's would, because I think the average person on the street is very well familiar with the McDonald's brand. They may not be as familiar with the Burger King brand. The third important point, and I think this is probably one of the reasons that PVR and Inox at some level merged as well, because PVR was very strong in the NCR region and Inox pretty much had all of South Bombay in its control, is real estate. This is as much a real estate business as it is a foods business. So you will find when Burger King has to enter the territory of McDonald's, most of the prime properties at McDonald's that are available are already taken by McDonald's, so their rentals will actually be higher. And McDonald's does not run that risk, the listed entity, because they don't have to open the stores in North and East because they just have half the franchise. So I think there are a lot of other points. And then, the point we were making about capital allocation, Surabhi, a little earlier, a lot of people say, look at numbers, X this, X that. The fact is that if you've incurred the capital, why should I look at anything X of anything, right? The fact is the Indonesia business is part of your consolidated business and you are running a 250 crore annualized loss. So why should I look at, actually, even the India business, if you annualize it, Surabhi, is going to be at a 100 crore loss. So I have no visibility on when this company will make a profit, whether it does so in 25, 26, 27.
Yeah.
But here I have a company that's, already sitting at about 30%, 33% kind of return on capital employed, 26% return on equity, and 20% plus margin. And the best part, Surabhi, is the valuation, right? I mean, McDonald's is coming to you at 20 times EV/EBITDA. Most consumer discretionary companies in India are coming to you between 25 to 30. So if I'm looking over the next 5 years, I think the runway to growth and valuations both marry. So even though the Westlife stock has gone from 250 to 750, there is no reason to suggest why 750 can't become 1500. So I think there are, it's one of those rare things where multiple things are firing at the same time. And there are reasons that I have sort of, given you as to why I would prefer it to pretty much every other listed QSR player in India at this point.
Got that. That's a lot of passion coming out. We can completely sense it, Rahul. And I'm old school, so I've never understood the concept of adjusted profits and adjusted EBITDA, and then you're positive at some adjusted level. If you could keep adjusting life, then it would all be perfect, right? But anyway, jokes apart. So ending with the big question, it's a 65-70% dream run already for Westlife. If someone wants to get into this for a slightly more longer haul, let's say 2 to 3 years, what kind of sort of an upside can they hope to get now coming in at this elevated level?
So, Surabhi, I think the fact that this stock has already, tripled from its COVID lows, I think it would be reasonable to expect a 20% compounded is my sense. So I think over a certain period of time, I would not be surprised to see the stock doubling even from here. It may not happen immediately. It may probably test you for 3-4 years. But I think you could easily look for a 20% compounding because you will, if you just plot, I mean, Surabhi, if you get your own team to just plot the same store sales growth of Westlife to Jubilant, you'll find that the dining business has actually outperformed the delivery business. So I don't see why, these metrics that have worked for Westlife cannot continue to work for them or get better. But like I said, I think from an investor's perspective, I still think you can expect a reasonable 20% compounding. And eventually, I think, over a period of time, there'll be some years it will probably give you more, some years a little less. But my sense is somewhere over the next 3 to 4 years, I would not be surprised if the stock doubles. Interestingly, so we keep talking about demographic dividend, right? There's not one single consumer discretionary play in aviation, QSR, or hotels that has $1 billion top line in India. So, we never know where we're going as penetration increases. And I think, McDonald's is probably going to be at the forefront of it all. It's a $100 billion global franchise. So I think there's one entity that understands the QSR business. You've got your answer right there.
Well, with the peri peri paneer and chatpata chicken or whatever kind of innovations they keep doing, they have, got the taste buds of the Indian consumer, that's for sure. Rahul, before we sign out, disclosures, if any.
Not a holder in any of these stocks right now, Surabhi. I'm sure maybe my team or the company may be having some exposure in some of these, but personally not holding any of these at this point.
All right, fantastic. Thank you very much for joining in. That's been an appetizing conversation. We wish you a good weekend and hope to see you a little more frequently on Who Moved the Market. Thanks for joining in.
Thank you for having me, sir.
Well, we're completely out of time on that note. So this is me signing off. See you again with more market themes next week.